Can we go live? So, hello everyone. Hello. Hope all of you are doing well. I am pleased to invite all of you for a very interactive discussion today. I am joined by Mr. Mahendra Jajoo, CIO Fixed Income with me to discuss on a very interesting product category. Before we start today's discussion, I want to introduce today's panel to all of you. For our friends who are joining us on YouTube and LinkedIn, if you want to attend the session on the platform, there is a link through which you can click and register on the platform. Otherwise, you can also enjoy the session on the LinkedIn and the YouTube platform as well. So people who have logged in on the platform, you will be a screen in front of you. The first tab is post a question. So in case you want to post a question, you can click on that tab. You can write your question and submit it. My only request to all participants is that please reserve your questions after the end of the presentation, because most of the questions may be answered during the presentation. So feel free to ask as many questions as possible, but just wait for the presentation to get over. The second tab is a polling tab. To make this session interesting, we have 4 polls today. So for the participants on the platform, when I announce that there is a poll, please click on the poll button. The poll options will be in front of you and choose your option. You have 30 seconds to take part in the poll. For our friends on YouTube and LinkedIn, I will tell you what is the response of the participants on the poll questions and what has been the reply. And that will give us a sense of what people are thinking of the various polls that we have done. The third is we have a quiz, and we will have one quiz during today's session, and the person who answers the right answer for that quiz gets a gift hamper from Mirae Asset, and we will announce the winner for today's quiz live. So for participating in the quiz, for participants in the platform, click on the quiz option. When I announce that the quiz is live now, you will have 30 seconds to take part in the quiz and provide your response. The fourth is a case where you can download various marketing collaterals for Mirae Asset Corporate Bond Fund. So please, you can download our product presentation, one-pagers, forms, videos, and other collaterals. And the last is the feedback section where participants on the platform can give the feedback. Also request to all the participants on YouTube and LinkedIn to also give how they found the session to be. The idea of today's session is to be very interactive and try and cover various questions from all our participants. So with this as a background, let me start. The recent accidents or incidents that have happened over the last couple of years have actually highlighted the importance of investing in high quality debt instruments. I'm reminded of a quote that Mr. Mahendra Jajoo uses very frequently in all his communication, that interest rate risk is temporary while credit risk is permanent. With this as the backdrop, let me start with poll number 1. So participants on the platform, please click on the poll option. The question for everyone and for my LinkedIn and YouTube participants, please hear the question. How many of you agree with the statement that interest rate risk is temporary while credit risk is permanent? The 4 options are totally agree, second, partially agree, third, partially disagree, and fourth, totally disagree. Please poll in your replies quickly. You have 30 seconds to reply. Just give me a second as I also try and put my poll answer to this one. So I have done my polling. You have 30 seconds now to pull in the answers. We already have about 60 participants providing the replies. Okay, very interesting. 75 participants have replied. We'll just wait another 10 seconds so that we get more answers. Okay, so Mr. Jajoo, I think the results are there. 68% of the participants totally agree with the statement. 26% of the participants partially agree. About 3% each partially disagree or totally disagree. So I can say majority, about 95% of the participants sort of more or less agree with the statement. Can we just have your couple of lines views on this before we move ahead?
Well, I'm very happy that there is increased awareness of the fact that investing into the debt mutual funds has to be on the side of being conservative, on the side of preferring safety. And I'm happy to see so many people acknowledge and appreciate that. So thank you very much, all the people who have participated.
Thank you, Mr. Jajoo. So I'm pleased to tell all my friends today on the platform on YouTube, LinkedIn, that we at Team Mirai are enhancing our product basket by launching a product called Mirai Asset Corporate Bond Fund. Mirai Asset Corporate Bond Fund is a product which will predominantly invest in highly rated debt and money market instruments, but mainly AA plus and above corporate bonds. We believe corporate bonds is a very important category and a category which should be a part of a core portfolio for any debt investor. To explain the investment strategy of our fund and share the debt market outlook, I would now like to welcome Mr. Mahendra Jajoo, CIO Fixed Income. For all the participants, we will take questions from all our esteemed audience after Mr. Jajoo's presentation. So please post your question on the platform as well as the YouTube and LinkedIn, and we'll take presentations from all of you after Mr. Jajoo's presentation. So over to you, sir.
Thank you, Vaibhav, and good afternoon, everyone. Over the next half an hour, I'll try to take you quickly through the market outlook for fixed income as we see the markets today. I'll briefly touch upon our investment process and the flexible interest rate strategy, and then I will give you a quick understanding of the corporate bond fund. Let me start with sharing my presentation. And at this point of time, I believe that we are in a transitory phase. Now, to understand how the markets are likely to evolve as far as fixed income is concerned, we need to go back about a year, and then we need to look at the fact that for the last 1 year, the Reserve Bank has been following an ultra-loose monetary policy, and that was with two primary objectives. One was to stabilize the financial markets. You will recall there was a huge sell-off in the March of last year once the lockdowns were imposed, and therefore the Reserve Bank intervened in the market, cut rates, injected liquidity, and then the financial markets stabilized. And the second objective of the Reserve Bank to have followed a very supportive monetary policy was to then support the recovery in the economic growth, which started after the gradual unlocks started from July onwards. So why is today a transitory phase? Because today we have a significant improvement in the COVID situation, and the economy is beginning to rebound very, very strongly. And therefore, the two reasons for which the Reserve Bank started with the ultra-loose monetary policy are beginning to fade away. And therefore, the Reserve Bank is expected to move towards normalization of the monetary policy in due course. We have already seen RBI take two steps towards normalization of the monetary policy. The first was to roll back the CRR cut of 1%, which was given last year for up to 1 year ending in March. And now that CRR will be increased from 3 to 4% in two phases. And second is that the Reserve Bank has started conducting flexible rate reverse repos, which in a way sucks out some liquidity from the market. But even as the RBI begins the normalization process, we still have two challenges. One is that the COVID situation can relapse. We have seen in developed markets like US and Europe that there was a very strong second wave. For the last 1 week, we are seeing some escalation in the number of daily cases, even in India. So we have to be on guard to make sure that there is complete recovery from COVID. And then the economic recovery that is happening right now is still nascent in nature. We are in the early phase of the economic recovery. So it needs the support of the monetary policy till the time the growth becomes self-sustainable. And therefore, there is still need for the Reserve Bank to continue to have a monetary policy stance, which is accommodative. So what do we see things going ahead? First is that we expect the Reserve Bank to continue to be adopting a easy monetary policy stance. And there are two factors which will help the Reserve Bank in being able to retain a low or easy policy stance. First is that the global policy tailwind is very much in favor of the lower interest rates. Most of the global central banks, like the Federal Reserve or ECB, are still very, very supportive of keeping interest rates low. And then second, the macro fundamentals for India are pretty stable and quite encouraging. For whatever it is worth, the headline inflation has fallen to 4.09% in February. So RBI has a lot of elbow room to keep the interest rates low. However, there are two challenges again for the Reserve Bank. One is that there is a expectation that in the global or the developed markets, the inflation can come back. We have seen the US 10-year yield go to around 1.4% from 0.65 in October, November. So there is a belief that inflation can make a comeback. Why this time there is a higher confidence in inflation coming back? Because in the last 10 years, the excess liquidity and low interest rates in the global environment was largely a monetary policy-led quantitative easing. But this time, in the last 1 year, we have seen post-COVID huge fiscal deficit by major governments. Even conservative countries like Germany and Singapore have taken a 20% fiscal deficit of the GDP. Therefore, when the government spends this kind of money, there is always a possibility that because of the high liquidity going into the broader economy and the demand that it creates, there can be a possibility of inflation coming back. The second challenge that we have is the very high government borrowing program. And then if the economy is expected to grow at about 10% plus, then the corporate credit will pick up also at some point. So there is going to be huge supply. And therefore, in context of that, there will be challenge in maintaining the interest rates at low level. In going forward, we also have to see how the monsoon pans out, because monsoon is a very key component of India. So this is the big picture. We have moved from ultra loose monetary policy to the path of the normalization of the monetary policy. At what pace it can happen and for how long it will take, we have to wait and see, because it will depend on how the new information comes. But this is the big picture. Let me just spend now 2 minutes in dealing with some of the individual components of this. So if you look at the COVID situation, as I said, it has improved dramatically from about 1 lakh cases per day in September. Now the daily case count has fallen to about 15,000. And within that, a large majority of those cases are coming from only 2 states, which is Maharashtra and Kerala. So rest of India is, very, very comfortable in terms of the COVID. From a total outstanding active case count of about 10 lakhs in September, now the number has come down to about 1.5 lakhs. And then this has happened at a time when we had the peak festive season like Diwali and other festivals. We had elections in so many states where large number of people were gathering together. And then we had the winter in particularly in the north of India. So in spite of these kind of super spreader events, we continue to see improvement in the COVID situation. Now there are 2 vaccines which are already in market. More than 1 crore Indians have already been vaccinated. There are a couple of more vaccines which are in pipeline, and now the vaccination is moving to the general public. So 60 plus and 45 plus with comorbidities. Already the government has announced a plan to vaccinate them from 1st of March, which is Monday. So I think there is a good amount of confidence that we can have that COVID situation will continue to improve. If you look at the GDP, it contracted by 24% in the Q1 of FY21, and then the contraction narrowed to 7.5% after the unlocking gradually started in July. This quarter to March of 2021, I believe the economy will already post a positive growth rate, and then the RBI has projected a real GDP growth of 10.5% in FY22, and the government budget had projected a GDP nominal GDP growth of 14.4% for the next year. So therefore, there is again a very good news that the economy should continue to improve. My personal view is that the growth will surprise us on the positive side. I expect the growth to be still higher than 14.5% on nominal basis. As far as the CPI inflation is concerned, after hitting a high of 7.61% in November, it has now fallen to 4.09 in February. So, which is a very good news, because for whatever it is worth, a headline number of 4.09% gives the Reserve Bank a lot of room to maintain low interest rates. Now, inflation is expected to remain low, around 4.5 to 5% in the first half of 21. That is till about June. The only challenge is that the core inflation is very sticky at around 5.5%. Then you look at the next important factor for the fixed income markets. Monetary policy all around the world, including in India, is still very, very accommodative. And finally, if you look at the fiscal deficit number is much higher than what the market was expecting. For FY21, the fiscal deficit is projected at 9.5%. For FY22, the fiscal deficit is projected at 6.8%. There is a lot of happiness about the improved quality of the fiscal deficit this time, primarily for two reasons. One is that a lot of the off-balance sheet items like the food subsidy to Food Corporation of India, which was earlier being routed through the National Small Savings Scheme, now the government has brought all the off-balance sheet items to the main budget document. So there is a appreciation about the improved quality of the fiscal deficit. And then second part is there is a lot of emphasis on the capital expenditure, which will promote growth, which will generate employment and so on. So the allocation to the capital expenditure has been increased significantly. So there is, I think, in the analyst community, a lot of positive vibe because of the improved quality of the fiscal deficit and therefore the credibility and transparency and so on. But from the fixed income markets perspective, a higher deficit is higher borrowing number, and therefore that is negative for the fixed income markets. That kind of a borrowing after 12 lakh crores in 2021, another 12 lakh crores in 2022, and then the government has said that they will try to bring the fiscal deficit down to 4.5% of GDP by 2026. Therefore, the prospect of continued high borrowings in subsequent years also is a big challenge for the fixed income market. Coming back to the global markets, as we discussed, all the global central banks are very, very supportive of low interest rates. The growth outlook globally is very, very disappointing. I mean, in Europe, in US, the people are struggling for growth even before COVID, and post-COVID, there is going to be still more challenge now, although the COVID situation is coming back to normal, but still, I think people are very, very, disappointed with the growth prospect. You look at the COVID situation globally, there was a strong second wave of COVID in US, in Europe, in Japan. Now we are seeing the case numbers are coming down. In US, for example, after hitting a high of about 2 lakh cases per day, that has fallen to about 50,000 per day. Same thing with the UK, where we had about 50,000 cases per day. Now it is somewhere closer to 10,000 per day. There are 3 vaccines which are already operational in US, Pfizer, Moderna, and AstraZeneca. 10% of the US population already have had COVID, and another 30% has been vaccinated. The first shot has been given. So largely, I think we are looking at improving COVID situation globally also. There are 2 vaccines, Russian vaccine and the Chinese vaccine, which is increasingly getting accepted in the tier 2 countries like Philippines or Nigeria and some of the other South Africa, some of those tier 2 countries. So not only the rich and the developed countries, even in the tier 2 countries now, the vaccination is going to take place at a quick pace in the next few months. Then finally, coming to the geopolitical scenario, the new US president is expected to be more diplomatic and polished and nuanced in dealing with the differences with China. So while the disagreement and differences will remain with China, most likely the nasty headlines that we see on a day-to-day basis earlier will possibly subside, and therefore the day-to-day headache for the market in terms of the volatility or uncertainty will possibly come down. And as far as India-China is concerned, we got some of the best news in the last 1 week that the troops are beginning to disengage on the border at LAC in Ladakh and so on. So I think from a geopolitical perspective also right now the global environment seems to be pretty benign, and especially with India, the biggest border tension with China is also easing out. So having understood the big picture, having looked at the individual components, what do we make out as to what will happen to interest rates, where the fixed income markets will go? We can make a few conclusions that RBI will certainly remain extremely accommodative. They will want the interest rates to remain low. The high frequency data very clearly suggests that GDP will grow at a very fantastic rate. My personal view, as I already mentioned earlier also, is that growth will surprise us on the positive side. The government had kept the fiscal stimulus back. They always said that once the COVID situation improves, they will go all out. So now with a 6.8% fiscal deficit target for next year, with a huge divestment program, with the focus on the capital expenditure, we can expect a lot of initiatives which will promote growth, which will promote jobs and so on. Finally, coming to inflation. Now, other three things are positive, but the inflation to my mind is a little bit of concern, because as of today, the inflation situation is pretty encouraging, but then we have multiple reasons to be worried about inflation. First is that the oil prices are at more than 1 year high. Most of the metal prices, commodity prices are at multiple year high. Copper has crossed $9,000 per ton, and steel and cement prices are very high at multi-year high. Even the government has complained that the high cement and steel prices are now causing problem in the infrastructure spending because the costs are going up. The demand is surging like never before. We have seen a very strong earnings growth, EBITDA growth from the corporate India. And then we have seen how the auto companies, which were having a negative growth even prior to COVID, are now having a 3 to 5 months waiting time for the cars. So there is a huge demand surge which is happening. And then when our economy is to grow at 10% plus, the current account deficit will also widen in coming months because our imports will pick up. So there are telltale signs of inflation making a strong comeback in India. And I already said that in global markets, there's a concern about inflation coming back. So looking at this situation, there are a few things which are sounding alarming. Reserve Bank has kind of indicated that they are very close to the end of their rate cut cycle. At best, if at all they give a rate cut, that the market will take it as the last rate cut in cycle, and then the yield curve will start normalizing. The US 10-year yield has now breached 1% in January, and now it is at 1.4%. So if the global bond yields go up, that will be a big concern for India, because India's relative attractiveness will get affected. Our hopes are now resting on the successful vaccination drive and continued economic recovery. If those two things happen, that we can be a little more positive. And finally, and very important for me, monsoon is going to play a decisive role. So if the monsoon is normal in time, then that will have one scenario. If the monsoon is delayed, or if it is deficient, or if the spread of the monsoon is not proper, then that will have a serious challenge on the food and vegetable prices, and that can have impact on inflation, and therefore that can have impact on the monetary policy of the Reserve Bank of India. So given all these factors, what do we think will happen to interest rates? My view is that we are right now in a range-bound interest rate scenario where the market does not have the tailwind of the fundamentals to take the interest rates any lower, because we are already at near the record lows, and the Reserve Bank will not allow the rates to go up significantly through constant interventions by way of open market operations, by way of Operation Twist, and there are so many other tools that they can deploy. However, in the second half, as I said, we expect the pressure from the global markets, we expect pressure from the inflation, we expect pressure from the current account deficit, and the government borrowing program is very large. With the economy growing at 10% plus, the corporate credit will pick up. So there is a possibility that the corporate spreads will widen because the corporate credit demand will be crowded out by the large government sector borrowing. So I just want to leave you with one thought here. The scenario that we are building is that possibly in the coming months, not immediately, the interest rates will go up, and because of the large corporate borrowing, the corporate bond spreads may also widen. So there will be one of those unique opportunities where even the high quality companies, because their business is growing at 10% plus, they may come to the market to borrow because their working capital requirements will increase. So you may have a very, very strong possibility of a situation where high quality companies are borrowing at high rates and at a time when the corporate spreads are also very attractive. So that is one thought I want you to leave with at this point. I'll come back to it in a minute when I talk about the corporate bond fund. I guess you can already connect the dots and see why corporate bond is such a lovely product to have been launched at this point in time. Now, let me just spend 5 minutes on our investment process. We have a very simple philosophy. When we think interest rates are going up, we decrease the duration in our funds, and when we think interest rate environment is supportive and interest rates are expected to come down, we increase the duration in our fund. What it means is that in adverse market, the investors get a reasonable downside protection, and we are able to retain dry powder to deploy when the interest rates again begin to ease, and therefore the investor can hope for a reasonable participation in the market rally that happens. You have seen how our different funds have performed over the last 3.5 years that we have started our debt business again, short-term fund, dynamic bond fund, and then the banking and PSU debt fund. Now, it is very simple and intuitive to say, yeah, when interest rates are going up, bring down the duration and so on. How do we do it, right? It's not the trading call or just feeling when we get up in the morning. We have a very comprehensive process to analyze the macro environment. And how do we do it? We look at each of the variables that can affect interest rates. So I went into detail on how inflation, credit growth, current account deficit, each of these factors can behave. And then we looked at the global market, and then we come to this conclusion. We finally categorize our thoughts into one of the three categories: positive, neutral, or negative. If my global outlook is positive and domestic outlook is positive, then we will be positioning our funds aggressively, and so on. At this point of time, our global view is neutral and the domestic view is neutral to negative. And therefore, we are cautiously placed. We are not aggressive, we are not defensive, we are not too underweight or overweight, but we are cautious and we are watching the things carefully. Because at this point, as I explained, for the next 3-4 months, don't see too much action happening because Reserve Bank is in full control of the situation. But after that, I think they will also understand how the macroeconomic environment is evolving, and then the interest rates will move accordingly. Now, if we have this positioning and if we are cautious, then how do we implement it in our funds on a day-to-day basis? In a real life, how do we follow this model into our funds? So let me just give you an example of the short duration fund. Now, in short duration fund, as you all know, as per the SEBI guideline, we need to have a minimum duration of 1 year and the maximum duration of 3 years. So when we think that interest rates are going up, we bring the duration close to 1 year. And when we think that interest rates are going down, we take the duration close to 3 years. Therefore, you as an investor or as an advisor don't need to worry about where the interest rates are going, etc., etc. As long as you believe that we can take a better or reasonable call on how the interest rate environment is changing, then all you need to worry about is the investment horizon that you have and the risk preference that you have. So you will see on the horizontal axis, which is the x-axis, we have given the investment horizon 0 to 7 years, which is the investor's investment horizon. And then on the y-axis, which is the vertical axis, is the risk return profile of the investor. So low, medium, high risk. Now you can see clearly that we have the funds at the shorter end, like overnight liquid, which is suitable for the investors with a transactional surplus, very short-term surplus. Ultra short, low duration, suitable for people with 3 to 6 month surplus, don't want to take any market call on that. Then you have basically three categories in the duration bucket: the short duration fund, and the banking and PSU debt fund, and the corporate bond fund, of which the NFO is starting today, and then the dynamic bond fund. So short duration fund has a duration range of 1 to 3 years. In the banking and PSU debt fund and the corporate bond fund that we are launching, we are planning or targeting a duration range of 2 to 5 years. And then in dynamic bond fund, we are targeting a duration range of 1 to 10 years. So you can easily see that the short duration fund is a very conservative risk preference investor choice. The banking PSU debt fund and the corporate bond fund is for investors who want to participate in the market, get good returns when the market is performing, but who want a reasonable protection when the market condition is adverse. For them, the banking PSU debt fund and the corporate bond fund with a 2 to 5 year investment horizon, 2 to 5 year duration range, and with an investment horizon of 3 years and above is an excellent choice. And then the dynamic bond fund is for people who say, look, I want to make maximum money when the markets are good. I'm okay with a little bit higher volatility. So short duration fund for people who have a conservative risk preference, banking PSU and corporate bond fund for those with a moderate risk preference, and dynamic bond fund for people who want aggressive risk preference. Now, when I talk about the risk preference, I'm not looking at the possibility of huge loss or huge gain. I'm talking about the volatility induced by the interest rate movement, right? It's not that there is going to be a huge negative or something, because of the simple factor that the other pillar on which our investment philosophy is based is, as Vaibhav said, market risk is temporary and credit risk is permanent. So our belief is that, if you get trapped in an interest rate volatility cycle, as long as you have a investment horizon long enough, you will end up with an happy experience, because interest rates are cyclical in nature. Interest rates go up, central banks take action, they come down, again market takes action, interest rates go up. So that cycle has been there for any number of years. As long as you have patience and the ability to withstand volatility, you will always come up with good returns. But if you happen to meet one credit accident, then that can be fatal. We have seen in the last 3 years what kind of pain and trauma people have gone through. So our view is that if you are investing in debt mutual fund, if you want to be conservative, if you say that I prefer safety and return second, then the aggressive credit should be avoided. And then in all our funds across, from overnight to dynamic bond fund, we focus on high credit quality investments. We do not encourage in our funds aggressive credit or structured instruments like loan against shares or those kind of things. So you can be equally confident of a good credit quality across our funds. Therefore, I repeat, you need to just focus on your investment horizon and risk preference. And then I think it becomes so simple for you to choose which fund to go. And that is the beauty of our fund positioning, that all you need to know is about yourself, not about us. And then I think that's such an easy decision to come to. So that's broadly about our market outlook, about our investment process, and the positioning of our funds. Now I'll maybe want to spend a few minutes on the corporate bond fund. And I take you back to the conclusion of my market outlook, where I said that we expect the interest rates to inch up slightly and the corporate bond spreads to widen. And because the economy is going to grow at 10% plus, for example, we have seen Tisco talk about wanting to double its capacity from 20 million tons to 40 million tons. How many times do you see this kind of positive comment from large corporates in the last 3-5 years? So clearly India seems to be on a strong rebound, and therefore we are going to be in an environment where the interest rates are rising, the corporate bond spreads are widening, the high quality companies are looking for fresh capital. I mean, there cannot be any better time than this to look at the corporate bond fund. Now, there is one question that I face in all my interaction with the investors, that look, if on the one hand you say that interest rates are going up, if on the one hand you are saying that the corporate bond spreads are going to widen, then how is it a good time to invest in any debt fund? Forget about corporate bond fund. Should I not be actually redeeming from my funds? And I think the answer to that is very simple. There is a mismatch between how the investment should be done and then how sometimes one perceives that. Because let me give you a counter to that. Whenever there is a correction in the equity market, what is the first reaction? People say the valuations have become attractive, invest now, average now, add exposure, correction is a good opportunity to buy. So when the Nifty falls and the equity markets correct, it is the same thing as bond yields going up and valuations improving. So a 10% yield is better than 9%, and 9% is better than 8%. So I think there is a reason, there is a strong case for us to review how we look at debt market versus how we look at equities market, or how we look at gold. That gold has fallen, it's corrected. It is very simple. When interest rates go up, the debt market has corrected and it is time to take a fresh review. The second part is that obviously the cycles take their own time. Now, if you look at 2018, when 10-year yield was at 6%, and then within 2018, it hit a high of close to 9%. And then in 2020, it came back to 6%, right? So somebody who invested in 2018 when interest rates was going up was by default averaging out his cost, because please understand this, that when interest rates are going up, as I mentioned, that we will get a good opportunity to invest because corporates will be willing to borrow because the business is growing so for right reasons they're borrowing. The fund manager gets an opportunity to invest new money and the existing investments maturity into higher yield paper. So the best time to build a portfolio is when you get good quality companies to borrow and when the corrections are happening, when the yields are going up. And then people who stayed put through 2018 to 2020 had one of the most spectacular bond or interest rate rally anytime in the past, and then everyone ended up with fairly decent return, I would say close to or more than double digit. Same thing happened in 2016-18. Same thing happened in 2013 to 2016. So every time there is a correction or there is a up interest rate cycle, that is the time to invest and then sit through one complete interest rate cycle. That's the time you make good return. And it is not very different from what we say about all other asset classes like equity and all. So that is the first reason I think you should look at the corporate bond fund at this point in time. Now, in case of our corporate bond fund, and for all corporate bond funds, as you know, 80% minimum has to be invested in AAA or AA plus rated asset. There is a 20% discretionary component. In our case, even that 20% we will invest only in highly rated corporate bonds, or we will take some exposure to government bonds or treasury bills to allow us to operate our flexible interest rate strategy in terms of changing duration when required, and to maintain liquidity and to keep the portfolio quality very high. This, along with the better risk adjusted returns that we have seen in the past for this category, and for the taxation benefit that you get for the debt funds if you remain invested for more than 3 years, makes for a strong case in my view. Now, just quickly, I will tell you that the credit quality of the AAA and AA plus category is very high. In the past, in case of the bonds rated AAA at the time of investment by CRISIL, 98.78 of the bonds remained AAA throughout their life, and only 1.22% just got changed to AA, which means there is no history of default of any bond which was rated AAA by CRISIL. I know that everyone will talk about one case. Then there is a situation where AA category papers, 96% remained AA for the life of the bond, 1.3%, 1.38% got upgraded, only 2.37% got downgraded to A. There was virtually no default, only 0.02%. And then if you go down the rating, cycle series, then obviously you will see higher and higher. So like bonds rated C, 20% of them defaulted, 58% of them retained the rating. Now, same thing with the credit quality, low default rate. So CRISIL AAA companies, 1 year, 2 year, 3 year, you see default rate is next to nothing. And then as you come down, the default rate keeps increasing. Finally, the liquidity in the AAA, AA plus space is very high. As you can see, the orange and the blue bars, almost 85 to 90% of the volumes in the secondary market for corporate bonds are in the in the AAA, AA plus space. So I think there is a very strong case for the corporate bond funds as a category right now. And these are the products which meet the current requirement in terms of the safety, in terms of the quality of the portfolio, in terms of the attractiveness of the opportunity that is there. And with our flexible interest rate strategy on top, which will move the duration between 2 to 5, depending on how we think the interest rates are going to move. I think that is, in my view, a very comprehensive case. So thank you very much for your patience. And I hand it over back to Vaibhav. Thank you, Vaibhav.
Thank you, sir, for your very insightful session. And I am sure a lot of questions that participants had will be answered by today's discussion. So before we go ahead, let me put poll number 2 to all participants on the platform. Let me repeat this question for everyone. What category of debt funds will you recommend to your investors in the current market scenario? Or as investors, which category would you look at investing as? First option, banking and PSU debt fund. Second, corporate bond fund. Third, dynamic bond fund. And fourth, short-term fund. So request everyone, you have 30 seconds, click on the poll button and take part. Let me also just try my luck where I would make my investments. So I have done my voting. We have another 15 seconds. We have about 50% of the people who have voted so far. So please put in your votes very quickly. Just let's wait for another 10 seconds. Okay, so Mr. Jajoo, just we have more than 100 people who've responded on the poll. Let me read out the results. About 14% said banking and PSU debt fund, 31% seem convinced on corporate bond funds, about 13% are dynamic bond funds, and the larger pie, which is about 42%, is short-term funds. Maybe one or two words from you on this side?
Well, I think they have made a good choice, and I'm sure there is an element of individual situation in terms of the risk preference or investment horizon, etc., in choosing some of these options. But I think it's a very fair distribution of how the investors are also distributed. So again, once again, I appreciate and congratulate the participants for making the right choice.
Sure. Thanks, Mr. Jajoo. So let me tell all participants that we have the first quiz question. We have actually only one quiz question for today. And the participant who chooses the right answer will get a lucky draw gift hamper from Mirae Asset. The question is, which is the largest AUM debt fund for Mirae Asset? First option, Mirae Asset Banking PSU Debt Fund. Second, Mirae Asset Short Term Fund. Third, Mirae Asset Dynamic Bond Fund. Fourth option, Miresh said overnight fund. Please take part in the quiz and give your replies. Let me also try my luck if they allow me to get a gift hamper as well. So I have put in my answers. You have 20 seconds to reply. We have 50% people replying already. I'm waiting another 10 seconds for them. Okay, so let me read out what was the result. So about 20% of the participant chose banking PSU, 33% chose short term, 11% dynamic, and 25% overnight. So the answer is short term fund. And at the end of the session, we will choose the lucky draw winner from today. So Mr. Jajoo, we've seen few questions already come from our audience. So let me take those questions from our audience and ask you those questions. Even for participants on LinkedIn and YouTube, if you have any questions, please post it on the platform and we will take your questions. So Mr. Jajoo, the first question is, with respect to if yields are going up, should one enter into the 2 or 5 year maturity bucket 6 months from now? Should they wait for 6 months or they should make an investment now? And in continuation, if yields go up, what will be the impact on the newly created portfolio? This is a question from Neha.
Yeah, so I think that is something which is there in everyone's mind. Everyone is thinking, obviously, if the interest rates go up, then the NAV will get affected and so on. But I think if people are looking at 3-year investment horizon, if people are looking at long-term investment horizon, if they're looking to maximize the return, I think the time to enter the market is when the market is giving you value, market is giving you opportunity, and when the situation is good, then there will be no supply and no opportunity in a meaningful way to invest. So I think it is very important. I will repeat it one more time. It is our psychology when we look at debt fund, which is different from equity. So let me put it this way: equity Nifty is at around 15,000 plus today. A lot of people may feel in different ways about how the valuation is, but let's say people who think that market can correct or valuation can go down, I think that whole approach is good from a trading perspective. But I think the investors are not traders. Investors are long-term investors. My view is that in debt funds in particular, where the taxation angle is 3%, whatever little saving you can do by all the switching and taking market call gets wiped out, more than wiped out by just the taxation handicap that you suffer. The second is that I think, and I am being very, humble in saying this. I don't mean to, in any way offend anyone, but I think we always overestimate our ability to forecast markets, especially interest rates. On the one hand, we say that debt market is too complicated, etc. I think the best results, in my view, come when you let the portfolio sit through one complete interest rate cycle. That is when you get automatic SIP, averaging out, etc., whatever we call in the fund. Obviously, the impact is that for 3 months, 6 months, 9 months, your NAV can be negative. No one fund has given negative returns for more than a year. So that is the, patience time. That is the time when the portfolio is being built. So that is how I look at it. I feel that people, when interest rates go up, they think, Jane do, will invest when the interest rates have peaked. Then when interest rates start coming down, they think that, market has already run so much, so why should we invest now? So I would say that one should not try to time the market too much. Invest when you have money, invest when you can, and not bother too much about the volatility in the interest rate. Finally, especially in our case, where we have a flexible interest rate strategy, why does anyone need to even worry about the interest rate volatility? Because as I said, if we think interest rates are going up, we will bring down the duration
heavy
close to 2 years. And if we think interest rates are going down, we'll take it to 5 years. You can look at our banking and PSU debt fund, where we think that interest rates are possibly going to harden. We have already taken the duration closer to 2 years. You can look at our short-term fund in the last 3 years. When the interest rates went up in 2018, we kept the duration close to 1 year. Right now, again, when we think interest rates are going up, we have brought down the duration closer to 1.5 years. So if at all there is a concern on the possibility of interest rates going up and the volatility, do spend more time with us, do try to understand our flexible interest rate strategy in more detail. I think that will help you appreciate the situation and give you more confidence and comfort. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.